Welcome to the debate. Recently, a piece of paper was signed halfway across the world. And, well, within minutes, billions of dollars were wiped off the value of American energy companies.
Right. Well, airlines just suddenly looked like Wall Street's favorite investment.
Exactly. I mean, it is a textbook market rotation. But it begs a really crucial question about how financial markets actually process information.
And the headline driving all of this, just to establish it for everyone, is the announcement that the United States and Iran have reached an initial peace agreement, one that is intended to end their conflict and reopen the Strait of Hormuz.
Yeah. And the market reaction to that was, it was instantaneous and massive. Brent crude dropped more than 4%, right?
Yes, and West Texas Intermediate, or WTI, that fell around 5%.
Right. So today we are looking at a central disagreement. Are these immediate trading moves, rewarding the transport sectors and penalizing energy companies, are they an accurate pricing of new baseline realities? Or are they just a premature reaction to a highly unresolved logistical puzzle?
It is really a question of whether traders are pricing in reality or, pricing in a fantasy.
Well, I'm going to argue that the market is absolutely right here. The trading we are seeing accurately reflects the improved cost structure for fuel consumers and the reduced revenue expectations for producers.
But based on what? Just the headline?
Based on the math. The geopolitical risk premium has been mathematically removed, and the market is just correctly adjusting to that new math.
And I will argue that these trading moves are, well, overly optimistic. An agreement on paper completely ignores the grueling execution risks, right? And the complex physical hurdles of restoring supply.
You think they are ignoring the hurdles entirely?
I do. By treating a diplomatic headline as an immediate influx of physical barrels, the current sector rotation is just premature. It is overly aggressive.
Look, the math driving the market right now is completely straightforward, and more importantly, it is correct. The Strait of Hormuz handles roughly, 1/5 of global oil and liquefied natural gas supplies.
Yeah, about 20%.
Right. So when you have a geographic bottleneck that controls 20% of the world's energy supply, any threat to that choke point adds a specific dollar amount geopolitical risk premium to every single barrel traded globally.
Sure.
The moment an agreement is reached, that threat vanishes. And the premium, it evaporates with it.
I understand the spreadsheet logic there.
It goes beyond a spreadsheet, though. For fuel consumers like airlines and cruise operators, jet fuel and diesel represent primary operating expenses.
Absolutely.
So a sustained fall in prices clearly protects their margins. It improves their earnings forecasts, therefore rewarding these transport companies while marking down the oil producers is just the logical, evidence-based reaction. The market is an efficient discounting mechanism, and it is doing its job.
The logic looks clean on a screen, I will give you that. But my counter is that the market is treating an initial early-stage diplomatic agreement as a completed logistical process. How so?
Well, an agreement on paper does not instantly restore normal shipping conditions in the physical world. The market is pricing in this flawless execution of restoring Iranian oil exports and navigating incredibly dense sanctions.
But the market has to price forward.
The physical world does not move at the speed of a trading algorithm. That is my point.
Let us look at the clearest beneficiaries of this price drop to see where the market is acting rationally. If you are listening to this and wondering why transport stocks spiked, well, you have to look at the airlines first.
Right, the major carriers.
We're talking about major carriers like DAL, UAL, and AAL. For an airline, jet fuel is a massive variable cost. It often competes directly with labor for the top line item on the income statement.
Yeah, they consume billions of gallons annually.
Exactly. But it really helps to understand the mechanics. When you pull a barrel of crude out of the ground, you cannot just, pour it into a Boeing 777.
Obviously not.
You have to send it to a refinery, and the refinery applies heat and pressure to break the crude apart, literally cracking the hydrocarbon chains.
The crack spread?
Right. The difference between the raw crude cost and the price of the refined product is called the crack spread. As long as that refining crack spread holds relatively steady, a 5% drop in crude means a substantial cost reduction at the airport pump. Lower jet fuel costs directly protect airline operating margins.
I accept the premise regarding airlines. I really do. Jet fuel is a direct operating expense, and the margin expansion there is, well, it is tangible.
And the exact same logic applies to the cruise operators. Companies like CL, RCL, and CLH, they consume enormous quantities of marine fuel.
Yeah, the bunkering process.
Exactly. Cruise ships do not pull up to a standard gas station. They go through a process called bunkering, where these specialized barges pull alongside the ship in port, and they pump heavy marine fuel into the ship's massive internal tanks, or bunkers.
Those ships are effectively floating cities, so the volume they consume is staggering.
Staggering is the right word. And these cruise operators have major capital expenditures. They carry heavy debt loads from building those multi-billion-dollar ships.
Free cash flow is the main metric.
It is the main metric. Every analyst watches for these companies. So every single dollar saved on bunkering costs falls directly to the bottom line. It improves their voyage margins and accelerates cash flow generation, which they use to pay down that debt. The market buying these stocks is simply a rational calculation of improved profitability.
Okay, that is a compelling argument for passenger transport, but you are painting with way too broad a brush here. I push back strongly when we apply this exact same logic to the delivery and logistics sector.
Why? They move freight, they burn fuel.
The market is treating delivery companies like FDX, UPS, and JBHT exactly like airlines, and their financial architectures are entirely different.
You do not believe lower diesel prices help massive logistics networks. I mean, they operate thousands of trucks and cargo planes.
They absolutely burn fuel, yes, but we have to look at the mechanics of their shipper contracts. Logistics companies do not just absorb fuel price volatility, they pass it on.
Through surcharges.
Right. If you are a major retailer shipping millions of packages with UPS, you sign a long-term contract. That contract has a base rate and then an explicitly defined index-based fuel surcharge.
Meaning the surcharge fluctuates with the market price of diesel.
Precisely. That surcharge is usually tied directly to the national average diesel price published weekly by the government. So if diesel drops from $4 a gallon to $3.50, well, UPS pays less at the pump.
Right.
But the bill they send to that retailer is legally required to drop by a corresponding amount. The lower cost is passed directly along to the shipper.
So you were saying they never realize the profit.
Exactly. Because of these pass-through surcharges, lower diesel and aviation fuel prices do not flow directly into profit for logistics providers. In fact, falling fuel prices can actually compress their top-line revenue without expanding the bottom-line profit margin.
That is a fair point about the top line.
The market is cheering for a cost saving that these logistics companies never actually pocketed in the first place. Rewarding these stocks across the board is an oversimplification of how their revenue models actually work.
That is an incisive point about the pass-through mechanics. But let me give you a different perspective on why the market still favors them. While it is true that revenue drops due to lower build surcharges, lower fuel costs still reduce the working capital required to operate that massive fleet on a daily basis.
Working capital, sure.
More importantly, lower shipping costs stimulate overall volume.
By making it cheaper for the end consumer to order goods.
Right. If it costs less to ship goods, e-commerce volumes can increase, which benefits FedEx and UPS through higher network utilization rates. I mean, when you are running a fixed logistics network, adding marginal volume on top of your existing routes is pure profit.
Higher utilization is a secondary effect, though. And it takes multiple quarters for consumer behavior to change and for that volume to even materialize.
But the market prices the future.
The market is reacting today. Traders are pricing in immediate profit gains that simply will not show up in the next earnings report because the surcharges neutralize the immediate benefit.
I concede the lag in utilization benefits. It will take time for the volume to show up. But let us pivot to the other side of this trade, the energy producers.
The losers in this scenario, according to the market.
Exactly. The market immediately penalized integrated oil producers like XLM, CVX, and COP. This damage is obvious. Lower realized crude prices reduce upstream revenue, compress cash flow, and lower the net present value of their future production reserves.
Agreed.
But the situation is even more severe for the independent shale producers.
Because they lack the downstream refining buffers that the integrated majors possess? I mean, an integrated company like XOM pulls oil out of the ground, but they also refine it and sell it at gas stations. It provides a natural hedge.
Exactly. Independent shale producers do not have that hedge. Think of shale production less like owning a traditional factory and more like running up a down escalator. The base decline rates of these wells mean the flow naturally drops off very quickly.
The pressure drops rapidly after the initial fracturing.
It falls off a cliff in the first 12 to 18 months. Because of that natural decline, you have to continuously deploy capital, send out new rigs, drill new wells, just to keep your overall corporate production perfectly flat.
The treadmill never stops.
Right. Companies like DVN, FANG, and EOG are highly sensitive to WTI prices. When oil is at $80, your margins are expansive and you can afford that constant drilling.
But when it drops,
When it falls by 5% in a single day, the operating leverage flips. If WTI keeps declining, those independent producers will face strict investor scrutiny over whether they can maintain their drilling programs, pay their variable dividends, and continue the share repurchases. The sell-off here is completely justified by those operational mechanics.
I am sorry, but I just do not buy that entirely. Punishing all energy stocks equally ignores deep operational differences, especially when we look at the oilfield services sector.
You mean the guys drilling the wells?
Providing the tech, yeah. Consider companies like SLB, HAL, and BKR. They don't sell crude directly. They sell technology, pressure pumping, and well evaluation services.
But their clients are the ones slashing budgets.
Yes, their customers base drilling budgets on expected oil prices. But are we prematurely assuming producers will delay projects and reduce drilling based on an initial treaty before prices have even stabilized?
The market is forward-looking. If a shale producer sees WTI drop 5% in a day due to a structural agreement, their capital expenditure committee is immediately recalculating the viability of their next 50 wells. They will idle rigs to protect cash flow.
But capital expenditure cycles do not turn on a dime. Now, HAL does have prominent exposure to North American shale, where producers can idle rigs relatively quickly. But look at SLB and BKR.
The international players.
Right. They have broader international operations. We are talking about offshore, deep-water projects in the North Sea, the Middle East, and South America. Those projects have 5 to 10-year investment horizons.
You are arguing the long-term contracts insulate them.
Absolutely. An international producer does not cancel a multi-billion-dollar offshore rig contract because Brent crude dropped 4% on a diplomatic headline. The mobilization costs alone for an offshore rig are astronomical. You do not just turn the operation off and send everyone home because of a news alert.
They might not cancel the project outright, I will grant you that, but they will absolutely negotiate harder on service costs moving forward.
Margin pressure.
Exactly. If producers expect prices to remain lower over the medium term, the pricing power of SLB and BKR weakens. Financial markets are discounting future cash flows because the terminal value of these long-term service contracts is now under threat.
Well, that assumes the initial peace agreement holds perfectly and oil actually floods the market without friction, which brings us precisely to the operational reality and the execution risks.
Let us examine that operational reality then. The geopolitical risk premium was a tangible, mathematical addition to the price of crude. Traders price in probability models.
Right, risk times probability.
If there is a heightened probability of a supply disruption in the Strait of Hormuz, the market adds a premium to secure supply today. The moment the agreement was signed, that probability dropped. The premium vanished. This justifies the immediate sector rotation.
But the physical constraints remain.
Financial markets do not wait for the physical barrels to arrive before adjusting prices. They trade on the expected forward curve.
But what if the curve is wrong?
If flows approach pre-conflict levels, the market moves directly from shortage concerns to oversupply fears. The expectation of oversupply in 6 months pushes the spot price down today. If traders waited for the actual ships to dock, they would be months behind the trade. That requires a comprehensive repricing of the entire energy complex right now.
I focus on what traders should actually watch, rather than just the diplomatic headline. The operational execution here is fraught with bureaucratic and physical friction. First, watch whether the Strait of Hormuz reopens on schedule.
The agreement says it will.
The agreement does not instantly restore normal shipping conditions. The strait is incredibly physically constrained. We're talking 21 miles wide at its narrowest point, but the actual shipping lanes, the deep-water channels that can safely accommodate a fully loaded supertanker, are merely 2 miles wide in either direction.
2 miles is tight for a supertanker.
Exactly. You cannot just flood that channel with traffic overnight.
But the diplomatic barriers are falling, which allows the traffic to begin normalizing.
The diplomatic barriers are falling, yes, but the bureaucratic barriers are heavy. You have to secure tankers. Then you have to arrange maritime insurance. Maritime shipping is not insured by standard consumer companies. You have to use protection and indemnity clubs, or P&I clubs.
Explain why that slows the process down, though.
P&I clubs are mutual associations made up of the ship owners themselves. They pool their money to cover catastrophic open water risks like war and pollution. Because it is a mutual pool, a single mispriced risk, like a tanker hitting an undisclosed mine left over from the conflict, could bankrupt the entire club. Because of that architecture, they are notoriously, agonizingly slow to adjust their risk models after a conflict formally ends.
So the ships cannot sail without the insurance, and the insurance models take weeks to update.
Precisely. And then sanctions matter heavily here. How quickly will oil exports actually return? You cannot simply turn a pipeline back on and expect millions of barrels to hit the water the next day. You need a letter of credit from a major global bank guaranteeing the transaction. You cannot buy $50 million of crude oil without one.
The physical barrels take time, and banking compliance adds to that timeline.
Banks have massive compliance departments. They will not issue that letter of credit just because politicians shook hands on television. They need absolute, legally binding verification that every single layer of sanctions has been officially lifted by the governing bodies.
Red tape.
Exactly. Compliance departments at global banks must verify this before they process anything. If more Iranian oil entering the market is delayed by these compliance hurdles, the downward pressure on crude will reverse.
I see your point regarding the friction of physical logistics and banking compliance. It is true that maritime insurance and letters of credit take time to organize. However, my central premise remains that the market must price the information it has today.
Even if the information is incomplete.
The market is pricing the absolute certainty that the geopolitical risk is drastically lower than it was 48 hours ago.
But if that expectation is built on an overly optimistic timeline, the forward curve is mispriced. That is my core argument. The market is pricing in the absolute best-case scenario for execution. In global commodities, the best-case scenario rarely plays out exactly as drafted in a diplomatic treaty.
There are always hiccups.
Always. There are delays, contract disputes, and logistical bottlenecks. If the strait does not reopen on its exact schedule, the oversupply fears evaporate, and oil rallies right back, leaving those who blindly bought the transport stocks heavily exposed.
Well, that is a fair assessment of the physical constraints versus the financial models. Let us summarize our positions in light of this discussion. I maintain that the market's repricing accurately captures the changing cost structures for transport and the weakened revenue models for oil producers.
The spreadsheet logic.
Right. The removal of the geopolitical risk premium is a mathematical certainty following the agreement. Therefore, the rewards for companies like DAL and CCL and the penalties for independent producers like DVN and integrated majors like XOM reflect a completely rational adjustment to new baseline expectations.
And I maintain that the complexities of physical logistics, sanctions compliance, and actual shipping schedules make these trading moves overly optimistic. Treating an initial agreement as a completed influx of global supply ignores the reality of how maritime trade, insurance markets, and oilfield service contracts actually function.
We both agree that the true test will be monitoring the actual timeline of the Strait of Hormuz reopening, and then the physical volume of oil exports returning to the market.
Listeners must keep a close eye on the physical execution of the agreement, the tanker schedules, and the legal sanctions relief, rather than just reacting to the initial diplomatic headlines.
We are back to where we started. The gauge reading the pressure in this global system is still murky.
We are trying to measure precise changes based on diplomatic treaties, but the physical world always adds friction.
It does indeed. We will have to watch the water, not just the wire.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.